Today we're looking at a new trade flashpoint. China has issued a strong warning to Mexico over tariffs. This isn't just a headline, it could impact global trade, commodities, and even investment strategies. Mexico just announced plans to impose tariffs of up to 50% on Chinese cars and other products. Beijing fired back immediately, calling it a move that appeases U.S. pressure and warning of retaliation. Mexico's president, Claudia Sheinbaum, said she doesn't want conflict, but must protect local industries. The backdrop: the U.S., under Donald Trump's renewed protectionist stance, is pushing trade partners to hit Chinese goods harder. Why does this matter? China's exports to Mexico have nearly doubled since 2016, partly because Chinese companies moved operations there to avoid U.S. tariffs. At the same time, China runs a large trade surplus with Mexico, about $71 billion last year. Copper is another piece of the puzzle. Mexico supplies roughly 5% of China's copper ore imports, crucial for renewable energy and electric vehicles. So this isn't just about cars, it's about strategic resources too. If Mexico follows through, here's what could happen. Retaliation risk: China could target Mexican exports such as copper ore. But since global demand is high, Mexico might find other buyers. Auto industry pressure: tariffs would raise costs for Chinese EVs, slowing their expansion in Mexico, while protecting Mexican and U.S. automakers. Geopolitical balancing act: Mexico risks straining ties with either Washington or Beijing, making it harder to stay neutral. From an investment perspective, three sectors stand out. Autos: U.S. and Mexican carmakers may gain market share if Chinese imports face heavy tariffs. That could benefit companies like GM or Ford in the North American market. Commodities: copper is called the metal of electrification. If China retaliates, it may push copper prices higher. That supports major global miners such as BHP or Rio Tinto. Safe havens and supply chains: rising trade tensions add uncertainty. Investors often turn to gold and U.S. treasuries for stability. Longer term, watch how manufacturing shifts. Some industries may move back to Southeast Asia or even the U.S. itself. To sum up, Mexico's tariff plan isn't just a domestic move. It's part of the larger U.S.-China trade war. For Mexico, the challenge is clear: protect its industries without getting crushed between two giants. And for investors, it's a reminder that global politics and global markets are deeply connected. So what do you think? Will Mexico lean toward the U.S. or try to keep a fragile balance with China? Share your thoughts in the comments and subscribe for more global business insights.